Well, you never know where the markets are headed. In the last few days, it's been good for gold, and then it's good to have a gold bug with you. Let's say hello to our friend Peter Schiff. Hey, Peter.
Hey, Robert.
How's it see you, my friend? We just happened to be at FreedomFest, and we're talking about the broader picture economics, and then boom, silver takes a jump. Gold is high. Today was a big day in the markets.
Well, unfortunately, it's a big day because of, war potentially in the Middle East. I mean, it's never a good thing. When you see this kind of stuff happening, hopefully this will not turn into something bigger than it is. I mean, people out there saying World War III, and generally that's not the case. In fact, the markets would probably be reacting a lot more if people thought this was the beginning of World War III. But, it did send oil prices up. At one point, I think last night they were up 10%.
Yeah.
Oil was at like 73, 74. And that's over a 30% move from where it was 3 weeks ago. So it's a pretty big move because a lot of people were hanging their hopes on falling oil prices for rate cuts and lower inflation. And, that's gone because oil's headed higher. But gold almost hit a new all-time high overnight. It came probably within $10 or $20.
Yeah.
But I think it could have its highest close ever. I think when I stopped looking at it, it was around 34.50.
Yeah.
But last week we got the breakout in silver where not only did it get above 35, it got above 36, almost hit 37.
Yeah.
And right now we're still 36 and change on silver. Gold stocks hit 52-week highs today. The GDX hit a 52-week high. And I think significantly, both Newmont and Barrick, which had been two of the stocks that hadn't made new highs, finally did that today.
Yeah.
In fact, Barrick hit its highest level since 2012. But those stocks have been very cheap for a while. It's been some of the mid-tier companies that have really stolen the show recently with bigger moves. But now you're seeing this, move in the biggest ones, which to me shows more institutional money looking for size coming into those stocks. And so, this is going to be a bigger move than what we've seen so far. But what's really significant about it, I'm going to talk about this, today, is the fact that we've had this, geopolitical event. We got missiles, going up back and forth now between Israel and Iran. And instead of investors buying treasuries, they're dumping treasuries, right? Treasuries are going down. They're not getting a safe haven bid. The dollar did rise slightly, but only off of a 3-year low that it hit yesterday. So it's barely up. It's gold that is getting the safe haven money. Of course, Bitcoin, fool's gold, is down too with the NASDAQ and the stock market. But the fact that U.S. dollars and U.S. treasuries are not the safe haven is a game changer for not only investors, but for Americans with our standard of living. Because the days of, coasting on the dollar's reserve status are over. And we're going to see a significant increase in consumer prices and interest rates over time and weakness in our financial markets. And so we're going to be seeing a rising cost of living, but our assets are going to be going down. The opposite of what we had before, where stocks and bonds or real estate were going up and prices were kind of held in check. All this is going to reverse.
Well, anytime that there is global uncertainty, then you see the markets react to that. And we can't belittle the fact that this is a serious issue. But at the same time, long term, what investors have to think about is how do they protect what they have, but still try to grow their wealth. And that's been a challenge. Back to gold for a minute, the majors, the companies you talked about, those are more of the institutional choices. Then you have kind of the miners and the junior miners, and you've talked about for a long time how undervalued they've been when you consider the value of gold has gone up, but the gold in the ground, they haven't gotten credit for that.
No, I mean, I put out a special report a couple months ago on the best way to buy gold, and it was buying gold mining stocks.
Yeah.
And the reason I thought that was the best way to buy it is because you're still buying gold, because the gold mining companies own gold, right? They have it, but it's still in the ground. They just haven't dug it up yet. But that below ground gold was trading historically cheap relative to what's it's worth after you dig it up.
Yeah.
And so it seemed to me like, well, if you didn't buy $2,000 gold, now it's $3,300. You can buy gold mining stocks that are the same price as they were when gold was $2,000. It's like that move never even happened.
Right.
But they're going to catch up. And I think people are going to look back who didn't buy these stocks of how could I have not done this? Right? You know, there's an investment, a no-brainer, but sometimes the no-brainers aren't obvious until hindsight.
Right.
And you look back and you say, gee, how could I have been so dumb? Why didn't I buy that? And so I was really trying to get even a lot of our clients at Schiff Gold to say, hey, you've been buying gold from me for 10, 15 years. Buy gold mining stocks now, because this is, yes, gold's going to keep going up, but you can get much better buy on the stocks. You make more money. And then I started really recommending silver too, which I think is now just starting to move.
Yeah.
I would not be surprised to see $100 silver next year. And, so that's a triple from here. I don't think gold's going to triple in the next year. I mean, it could, but if it just goes up 50%, you're talking about like $5,000 gold.
Right.
But $5,000 gold and $200 silver would be what, 50 to 1, which is still not even that expensive for silver. It's still kind of cheap, I think.
Yeah.
We were at 100 to 1 a couple of weeks ago.
Yeah.
And now we're about 90 to 1. So,
And historically, that ratio has been even lower. I mean, in recent years, it's probably hovered around 80, and in the last year, it's higher to 100. But there was a point when it was 20 ounces of silver, about 1 ounce of gold.
well, that was the official rate.
Yeah.
That was, because that's what it was. If you had 20 silver dollars, you got a $20 gold piece.
They used to do the math back then, yes. Well, let's talk about one of your favorite topics, tariffs. They had a really interesting panel here. They called it Terrifying. There's what we heard, and you've been talking about this on your show, of course, and now are we starting to see it get to where it's going to be, or is there still a lot of concern in the markets about tariffs?
Yeah, well, there's not a lot of concern. There's a lot of ignorance and misunderstanding about what tariffs are.
Right.
Especially among Republicans who all of a sudden are clueless about a tariff. But a tariff is just a tax.
Yeah.
And it's a tax on imports. The tax is levied on the importer. So if you want to import something, when it comes across the border, you got to pay a tax.
Yeah.
The producer doesn't pay the tax. He just ships the goods over. It's whoever buys it that pays the tax. Now, if you do it directly, let's say I directly order something made in China and they ship it, I'm going to have to pay a tax directly. I'm going to have to pay that tax because I was the importer. I've got to pay the tax to the government. But let's say I don't go to and order something directly from China. I just go to Amazon and buy something that was made in China. Amazon, when they bring that product in at the border, when it comes through the port, in order to get it released, they have to pay the tariff.
Yeah.
Now, what does Amazon do? Well, they got to mark up the product. That's just like their rent or their wages or their insurance. It's just a good part of the cost of doing business. And they're going to try to pass that on to the customer.
Yeah.
And so the customer ends up paying the tariff when they buy the goods. So it's an indirect tax. It's an excise tax. It's in the Constitution, right? But of course, the president is not authorized by the Constitution to impose tariffs, right? Congress has to do it. He has to sign off on it, but Congress has to pass it.
Yeah.
And it actually has to originate in the House. So the Senate can't even do it. They can only ratify what the House has already done, because the framers wanted all tax bills to start at the House because that was the most responsive body to the people. Because remember, back then, the senators weren't even elected. They were appointed by the state legislatures, and they had 6-year terms. But the House members, just like today, were elected by the people, and they had to run every 2 years. And so the founding fathers said, if you're going to vote for a tax increase, we want to make sure that you're held accountable for that at the polls, so you'll be reluctant to raise taxes. But I don't like what the president is doing, trying to use these fake emergencies and fake reciprocity to basically do what lawfully he doesn't have the authority to do. But the whole premise of the tariffs was wrong in that the idea was that, well, it's going to be external revenue, right? We're not going to have to pay this. China's going to pay it. Mexico is going to pay it. Canada. That was all BS to get votes. But now he's doing it anyway, even though he doesn't need the votes anymore. He's president, but he's still, selling this lie. And then anytime somebody says, oh, I'm going to have to raise prices, he beats them up. Like, well, you better not raise your prices. Well, what does he expect? Right. That's what tariffs do. That's how they help the domestic companies, supposedly, by making imports more expensive. Well, how do tariffs make imports more expensive? Because you have to raise the price. But the other flawed premise is when the basis for the tariffs is supposedly that foreigners are screwing us over. They're taking advantage of us. They're ripping us off. And so we got to hit them with these tariffs. But the reality is we've been taking advantage of the rest of the world. We've been ripping everybody off. The trade deficits simply reflect how much stuff we got to consume that we didn't have to produce.
That instead we traded for worthless fiat paper.
Right. We gave them our paper that we print for nothing.
Yeah.
And they gave us all these goods that they have to produce at great cost to themselves.
Yes.
They could have used that capital. They could have used that labor to produce stuff for themselves. But instead, they worked really hard to make stuff for us. We got the better end of the deal. They got the short stick. But Trump doesn't realize that. He thinks, we should make them pay for the privilege of providing us with stuff.
I think part of it's he fashions himself such a deal doer, and he's a real estate guy, and he brings that sensibility, but not this trade side. And yet he's surrounded by smart people, don't they?
No, they're smart. Probably on an IQ basis. Some of them don't seem too smart on economics when I hear them talk. But, all these deals, I think, are a bunch of BS. I mean, first of all Trump is going to do is he imposes these really high tariffs. And then in the deal, he just agrees to lower them.
Yeah.
But he's the one that raised them. And what happens is, so he raises tariffs, China raises tariffs in response. And now the deal is we both lower our tariffs. And he says, see, look, I won. What did you win? There are no deals to be made. Trade is relatively free throughout the world. Is it perfectly free? No, because there's always protection. You have farmers, you have other special interests that get protection. But tariffs hurt the country that imposes them more than the countries whose goods they're applied to. So if China has tariffs on American goods, that hurts the Chinese more than it hurts Americans. Right? So the best policy that you can have, regardless of what other people do, is free trade. Right? The freer, the better. And now, like, you look at these steel and aluminum tariffs that Trump has put on 50% now.
Yeah.
And I was watching Scott Bassett being interviewed, and a woman asked him, who was interviewing him, well, how are these steel tariffs going to affect the home building industry? And he said, well, I really don't know about that, but it's going to really help the steel industry. Well, yes, but it's going to hurt the home building industry because they buy steel. Right? And now all the steel they buy is going to be more expensive. And that's what politicians never look at, is the unintended consequences. Who gets hurt by these policies? But the irony is, in the long run, even the steel companies get hurt by steel tariffs because you destroy the businesses of their customers. So if the people that buy steel are in trouble and go out of business, what does that do to the sellers of steel? They have fewer customers.
Right.
So in the long run, everybody loses. And even if you're an exporter, if you're making a product that needs steel, and now you're paying 50% more for your steel, and your foreign competitors aren't paying 50% more for your steel, what happens to the competitiveness of your stuff? So some manufacturers are helped, but others are hurt. But overall, the country is hurt. Yes, the government raises some revenue from the tariffs, but the revenue it raises doesn't offset the harm that's done, because a lot of what happens is prices just go up because you don't buy the goods that have the tariffs. You buy some other good that's not subject to tariff but is more expensive. So the government doesn't get any tariff revenue, and the consumer has to pay more. So, or the business has to pay more. So it's just the solution to the problems we have is to cut government spending, and they're doing the opposite of that. The big beautiful bill increases government spending, which is the biggest disaster of the whole thing. Is that Republicans were hoping that with Elon Musk and Doge that we might finally turn the tide fiscally and address the exploding debt, and instead we're just making the problem worse. Not that Harris wouldn't have also made it worse. It's like every administration makes it worse, but people were hoping that this was going to be a game changer, and it's not. Same game. But I think it's going to be game over soon with a dollar crisis.
We're with Peter Schiff. We're talking about what's happened today in the markets, the idea of trade and tariff. And, there's more to trade than tariffs, obviously, Peter. To your point, free trade lets countries go back and forth with goods and services, and that's how we get access to lots more stuff. It makes it better for everybody.
Yeah, I mean, everybody wins in trade because remember, it's a voluntary exchange. And, America doesn't trade with China. Americans trade with Chinese.
Yeah.
Right. And so if some Chinese company makes something and I buy it, they didn't twist my arm, right? They didn't put a gun to my head. I bought it because I liked the product. Like there's a guy here that's selling these massage chairs.
Yeah.
And all of them are made in China. And I asked him the quality and he said, it's really good. And he said, yep, he's paying the tariffs now. He said he's not passing it all on. He's eating some of it himself. But he told me that the Chinese companies didn't cut the prices. So he's just making less money than he was making before. But I said, well, is there any way to make them here? And he said, well, at least they'd be triple the cost. So even a 55% tariff doesn't mean that he's going to start buying massage chairs that are made in America, right? Because they would be triple the cost. So it's still cheaper to import them and pay the tariff. But they can't even make them at triple the cost now because we don't even have the factories.
Right.
It would be years from now before we can make them at 3 times the cost of what we're buying them right now.
Right.
But if China can make it for a third of the cost, we would be foolish not to buy it from China because that means the money that we save because we didn't pay triple for the massage chair, we got money to buy something else.
Yeah.
And that something else might have been made in America, or it might be a service that's provided by an American.
Yeah.
So, anything that brings down the cost of living is good. Now, the problem is, if you want to look at why can't we make those chairs in America? Why can't we make it?
Yeah.
Get to the root cause of that. We need less government. We need lower regulations. We need lower taxes. Tariffs won't make us more competitive, right? The stuff that will make us more competitive, they don't want to do, right? So they just want to put a Band-Aid on the wound so we can't see it, but they're not going to treat it, right? So it's not going to get any better. It's actually going to get worse, underneath that Band-Aid.
So let's talk about investing outside of your nation's boundaries. As a stock investor, it doesn't matter where the company is to you, right? I think real estate investors, we're looking at location, we're looking at neighborhoods, we invest in different places. But for a long time, you've been investing internationally. And talk about the idea of that today. What are you looking for when you're looking for companies that make sense, stocks you want to add to your funds, those kinds of things?
Yeah, well, first of all, ever since I think 2011, 2012, since we got away with the QE and we had artificially low interest rates, and we had rising deficits, the world was willing to finance the deficits and recycle their trade surpluses into U.S. financial assets, predominantly the stock market, but also the bond market. So we had artificially low interest rates and an elevated stock market. And so Americans didn't really think about investing abroad because they were making so much more money investing domestically. Well, that's all turned. Year to date, the U.S. stock market is actually down a bit. But if you look at my foreign dividend payers strategy and my mutual fund, my foreign dividend payers fund, we're up better than 30% on the year.
Yeah.
Not annualized. 30%, we're not even halfway done the year.
Yeah.
So if you annualize it, it's almost like 70% return with a falling U.S. market. Now, I think this is the beginning of a shift that will last for a decade or more, where the U.S. market dramatically underperforms the rest of the world.
Yeah.
Not just because the stock markets abroad are going to do better, but because the dollar, which hit a 3-year low yesterday, is going to keep falling. And so as the dollar falls, that undermines returns for U.S. investments for foreigners, but that enhances the returns of foreign investments for Americans.
Yeah.
The gains are worth more, the dividends are worth more. And the whole time the U.S. stock market was outperforming, everybody knew that fundamentally our market was expensive. So if you looked at the foreign markets on a valuation basis, looked at a PE or a dividend yield, you would know that the U.S. market was more expensive. But it didn't matter because it kept going up. So the momentum trumped the valuations.
Yeah.
So even though U.S. stocks were expensive, you bought them anyway because you thought they would get more expensive. But now that the momentum has turned, valuation is much more important. Why overpay for U.S. stocks that are going down when you have a much better deal on foreign stocks that are going up? So I can buy foreign stocks that have a much lower valuation than U.S. stocks, but they're trending up, not going down, and they have a much higher dividend yield. So Americans have to recognize that the game has changed, and they have to stop investing in the rearview mirror and don't look at the S&P, don't look at the Mag 7. You got to start looking internationally at valuation and getting out of the dollar. And looking at the precious metals and look at the mining stocks and look at the resources and all that kind of stuff. And then look at emerging markets. This is where the money is going to be made over the next decade, a lot of money is going to be lost in U.S. financial assets, especially bonds. You're going to get crushed in bonds through inflation. Stocks, depending on the stocks that you own, but you won't do nearly as well in the U.S. market as you will, I think, internationally. So that's why, my strategy, this is really the time to recognize, Biden started it when he weaponized the dollar with the sanctions, and now Trump, finished the job with the tariffs, because now we've taken away all the reasons that foreigners would have for wanting to hold our dollars. And we've also told them that there's no chance we're going to get the deficits under control. The deficits are going to spiral. So the Fed is going to be monetizing, printing a lot of money. So why are you going to hold 30-year treasuries at 5% when, the dollar is going to lose a lot more than that every year? That's why they're buying gold, right? They're not buying, they're selling their treasuries and they're buying gold. Central banks are doing that. Foreigners are doing that. Soon Americans will be doing that.
A lot of ways to buy gold. You can buy physical metal. You can do that at schiffgold.com, or you can buy your gold fund. Adrian Day manages your gold fund. Talk about that.
Yeah, so the gold fund is gold mining stocks. But when you buy gold mining stocks, of course, the assets that the gold mines have is the gold that they're mining. Yeah. So you're still buying gold. You're just buying it below ground.
Earlier in the process.
Yeah, and then they pull it out of the ground and then they sell it. And most mining companies now, the big ones, their cost of mining gold is around $1,400, $1,500, $1,600 an ounce. But as soon as they get it out of the ground and they're selling it for $3,400 an ounce, that's a good business. Yeah. And it's going to get better because the price of gold is going to keep going up, I think, more than the cost of pulling it out of the ground. That wasn't the case for a long time. Gold prices were rising slower than the cost of mining. Right. So even though gold was going up, and people who own physical gold were doing really well, most mining stocks were not seeing the benefit. But now they are, but they're not priced for it. People are still pricing gold as if that gold mining stocks, as if that dynamic hasn't changed. That's why I came up with a special report on my Europack website, europack.com, the best way to buy gold, which was gold stocks. And since that report's come out, I mean, the stocks are probably up 30%, 40%. Yeah. So that they're outperforming gold, but they still have a ways to go. I mean, I recommend that people have both, that they have some physical gold, but as an investment, they buy these gold mining stocks and they also pay dividends, so it's not like, you don't get any dividend on your physical gold, but you will get dividends on most of the mining stocks, and they're going to be raising their dividends because their cash flow is just soaring because of their earnings. So they buy back stock, they pay dividends. So there's a lot of upside there. So we have separately managed accounts at Europe Pacific Asset Management, but anybody could buy the fund, the Europe Pacific Gold Fund. Yep. All the discount brokerage firms have it on their platform, but you can learn about the funds on my website, europack.com, and get the symbols and, get a prospectus and do all that.
All right. Last final Jeopardy. Interest rates. All the real estate investors are saying we need rates down. The president says rates need to go down. Do you see anything that's going to actually bring interest rates down in the near term?
Well, in the very near term, no. I do think that we've been in a recession for some time. That's one of the reasons that Trump got elected. And I think when it becomes more obvious to everybody that that is the case, whether we see it in the jobs numbers or other areas of the economy, I think we will get some rate cuts. But unless it's accompanied by QE, long-term rates are going to go up. Just like when the Fed was cutting rates before, long-term rates went up. So if the Fed cuts rates, and the long bond goes, up to 6% or 7%. Yeah. So as far as the real estate market is concerned, that's a hike because the money that people are borrowing to buy homes, they're not borrowing the Fed funds rate. They're getting a mortgage. And the mortgage are more priced off of a 10-year bond than a treasury, a 1 year or, overnight money. I don't think until the Fed goes back to QE, aggressive QE, will we see a short-term drop in long-term rates. And the reason I say short-term is eventually the inflation that the Fed unleashes with that QE program and the dollar weakness that will follow. It'll just take, the dollar will be in the downtrend and then it will accelerate. That will ultimately push long-term rates even higher. So the Fed will lose control over that. But the problem initially is the Fed starts printing money to buy bonds to keep interest rates from rising. Yeah. But the more money the Fed prints to buy bonds, the more inflation the Fed creates, the less attractive the bonds become. And so now more people wanted to sell them. And now they have to print more money to buy those, which makes inflation worse, which push more downward pressure. So the more they try to prop up the bond market by creating inflation, the more downward pressure they put up on the market they're trying to prop up. And then it's not just treasuries, because once the inflation is really out of the bag, well, corporate yields start to go up, municipal bonds. So now what is the Fed going to do? Oh, we're going to start buying muni bonds. We're going to start buying corporate bonds. Well, that's even more inflation. So the Fed destroys the bond market in its attempt to save it. And then you just potentially have hyperinflation. But at some point, the Fed has to say, all right, we're not doing this anymore, right? Then you have the Armageddon. But if you don't avoid it, you actually make it worse. Because if you take it to the nth degree and you never stop, then you destroy the currency completely and you have hyperinflation. And there's nothing worse than that. So sometimes that happens because the only way to stop it from happening means something really bad has to happen. And so instead of having something really bad happen, we have something even worse happen later, right? That's the political trade-off that seems to get made.
That's the continuous kicking the can down the road. Well, I wish we could talk about this for another week. And we can, yes. As we head off on the 23rd Annual Investor Summit at Sea. If you're not going to join us this year, then you must be listening to the Peter Schiff Show. You're pretty prolific. You do a podcast a couple times a week.
I've been doing one, and now that I'm on vacation, I probably do it most. In fact, I'll probably skip them some weeks. But we'll see.
But check it out. And
the Peter Schiff Show podcast is definitely a good listen.
It's a good listen for sure. There's Peter Schiff. Thanks, brother. Good to see you, my friend.
Thank you.